Airlines record 116% increase in traffic in April 2022. Nigerian National Petroleum Corporation Limited generates 1.7 trillion naira from crude oil sales in 12 months as oil prices record weekly gain amid high U.S. demand. Plus, China stocks lead gains in mixed Asia trading. This is Business Express on a network service of the NTA, and we are reaching you from Abuja, the nation's capital. I am Benny Adams, your guide. Good to have you join us on business. I'll start by telling you that Air Peace and other airlines traffic across Africa increased by 116.2% in April 2022 compared to a year ago in March 2021. This was disclosed by the International Air Transport Association IATA via a statement issued on Thursday, indicating that air travel continues to be in strong recovery trend. According to IATA, the development is an acceleration over the 93.3% year-over-year increase recorded in March 2022. African Airlines traffic rose 116.2% in April 2022 versus a year ago, an acceleration over the 93.3% year-over-year increase recorded in March 2022. April 2022 was up 65.7%. European carriers' April international traffic rose 480% versus April 2021. And the Nigerian Export Promotion Council, NEPC, is set to create trading platforms for Nigerian business communities across Africa and the global markets. During an interface with the business community in Lagos, Executive Director of the Council, Dr. Ezra Yakusak, urged Nigerian business owners to take advantage of the Nigeria Export Trade House in Cairo, Egypt, towards facilitating economic growth and market access.
We at the NEPC firmly believe that our survival as a nation depends on non-oil export, and that's why we are organizing this advocacy program to ensure or to make sure that our exporters leverage on the services that are going to be provided by the export trade houses.
Or a platform, a specially designated platform that will cater to show farmers and traders alike what is being bought at the other side of the world. We can assist to say, okay, we will buy it from you in 10-month cycle. And this 10-month cycle will create more money for you and will create stability.
The NEPC boss maintained that Nigeria has a huge commodity market, hence the need for aggressive marketing for improved value addition of Nigerian exportable products and produce in the North African region.
Bodies all over the world, and they've certified some of our products, and NEPC paid for it under the program called Go Global Gold Certification. And we've so far has facilitated the certification of about 150 SMEs now.
Modu reports that the council also met with agro-processors and producers who were informed of ongoing efforts to remove Nigeria from the EU restricted list and reinstating Nigeria imports into the international market. And the Central Bank of Nigeria, CBN, says it will sell 1.2 trillion naira worth of treasury bills in the third quarter of 2022. The Apex Bank disclosed this in its Nigeria Treasury Bills Issue Program for quarter 3 2022. T-bills are short-term debt instruments used by the CBN to borrow money from the public on behalf of the federal government. The Apex Bank also uses the paper to control money supply in the economy. The Treasury bills would be issued in tranches, with the first tranche roll out on June 2nd, 2022, while the last tranche is scheduled for August 25th, 2022. During the period, the Apex Bank will issue T-bills worth 33.4 billion naira on 91 days tenor, 22.9 billion naira on 182 days, and 1.17 trillion naira on 364 days. Revenue made by the Nigerian National Petroleum Corporation Limited from crude oil sales in 1 year has been put at 1.7 trillion naira. Corporation's latest monthly and financial report for August says the sum was earned from March 2020 to March 2021 after it lifted a total of 108 million barrels of crude oil within the year at an average price of $43 per barrel. A breakdown of the report showed that in March 2020, the oil and gas firm lifted approximately 9.49 million barrels, 11.437 million barrels in April, 5.113 million barrels in May, then 6.274 million barrels in June, and finally 8.546 million barrels in July. But in the month of January 2021, it lifted 5.542 million barrels, 9.397 million barrels in February, and 7.553 million barrels in March 2021, making it a total of 108 million barrels for the period under review. The crude, NNPC says, was lifted from the daily allocation for domestic utilization, translating to an average volume of 243,650 barrels of oil per day in terms of performance. And now, on Tuesday, June 7, 2022, the Debt Management Office said Nigeria's total public debt went up by 2.04 trillion naira, bringing the total debt stock to 41.6 trillion naira in the first quarter of 2020 from 39.56 trillion naira as of December 2021. What does this mean? What does this profile present or imply for the country's development is the focus of our discussion. And joining me is a professor of entrepreneurship and finance from the Kaduna State University. He is Yeshua Ibrahim Angu. Sir, you're welcome to Business Express.
My pleasure. Good afternoon.
Okay, Prof. From that brief introduction, what is your assessment of Nigeria's debt profile as it stands today?
Well, the first impression is that it is growing steadily. That is especially if you look at the domestic debt component of it and a little bit of the foreign component also. The implication, of course, is that there are concerns, and normally Nigerians, like most other people, are usually concerned when they hear these figures. But it's not unexpected that the debt profile will increase the way it has done. I think what is clear is that if you look at what happened in the last 2-3 years, with the COVID-19 and the other challenges that we face. If you remember, we have had a situation where the economy had to go into recession twice. All of these put together. And also on the other side, looking at the trajectory of the country's development trajectory, that is in terms of infrastructural development, all of these have impact. And naturally, the first impression most people will have is to say we are growing our debt profile and it's a matter of concern. But in reality, the debt profile compared to the GDP of Nigeria is relatively manageable and is sustainable. However, the concern is with the volume of debt service that Nigeria has to handle is reaching an alarming position and is becoming worrisome, that maybe if we continue on this trajectory, there may be concerns of sustainability of debt repayment. But in terms of quantum, it's not unexpected, considering the development in the economy, global economy as it is, and it's also not unexpected considering the infrastructural trajectory and development of the country. The country has invested so much in infrastructure in the last few years, and most of these were through bilateral or multilateral support. So that is expected. That is expected.
The fact that the debt to GDP ratio is within safe margin, and also looking at these borrowings, you've seen, or Nigerians are getting to see what some of these monies are being used for. Can you just give me a picture of the general implications of this debt profile to the economy vis-a-vis the issues of repayment plans?
Well, look at when I speak about infrastructure, look at the developments that are taking place in the country. In the last few years, the country has invested hugely in rail modernization projects. This requires money, and it requires an arrangement with foreign support. And then you look at what happened to the transportation sector in terms of airports. All the major airports have been remodeled, rebuilt completely. Look at the roads, the major roads projects that are taking place. Look at the bridges that are being built, historic ones. So all of these are monumental, and they require funding. Now, we had option. The country can decide to say, okay, I will wait, I will stall and wait until we have enough resources, then we can now go for infrastructure. But I don't think we can afford that. What we need, we have to invest in infrastructure if we have to catch up. It's through those investments that we actually will now need, we'll raise some revenue to even finance some of these borrowings. So that is one side. Another side, which I also highlighted earlier, was the issue of what happened to global economy during recession. Whether we like it or not, those things have global impact. And if you remember, we all know that a huge component of our foreign exchange comes from oil-related transactions. Now, we know what happened to oil prices during COVID and immediately after COVID. It's now that these prices have risen up. But before then, when the whole global economy was closed, that was a serious issue, that was a serious problem. So all of those have impact. I think, even though we have not come to that point, we need to look at our budgetary expenditure, and we have to look at what we can avoid. Whatever we can avoid, we have to avoid. But in terms of infrastructure, I think we are moving in the right direction, and we have to pay the price for it. And the price of it is in this kind of things that we are seeing, that our debt profile is rising. But the beauty of it is that we are seeing where these funds are being put. We are seeing the output or the results of what is being invested. I think our major task is to reduce recurrent expenditure where we can, and also improve the revenue projection. Also, that is a necessity that we have to look into.
Talking about looking at expenditure, how does government get to actually cut cost of governance vis-a-vis revenue generation to create a balance between debt and income coming in?
The one thing we need to do in this country, we need to tell ourselves, our situation. We need to publicize our situation. You can only, yes, of course, you can spend what you have. You can also borrow to spend. But in the situation we have, considering the choice the government has made for us, which is to invest in infrastructure, we need anything that is just recurrent, that is perhaps for our comfort, in our various offices or in our movements, in our lifestyles. When I say our lifestyles, I'm referring to lifestyles of those who are in government. So let's reduce those things, so that we can, face squarely our situation and then grow this economy then the economy can shoulder a lot of this. That is one. Another thing that is necessary, that is required, is in terms of where we are getting these revenues. Because our real crisis, sincerely, is not a debt crisis. We don't have any debt crisis. It's sustainable. We can hold on to this debt. But the problem is our ability to service the debt. Our ability to service the debt is a response, clearly, has direct bearing on our ability to raise revenues. Now, these revenues have increased substantially, I know. You know, if you look at what it was in the last 5-10 years, is substantial increase, including also diversifying the revenue. Because if you look at what we used to get in terms of tax revenue now from non-oil sector, is huge. However, I think sincerely, we have to tell ourselves, we have to make sure that wherever there are leakages, those leakages are blocked. We are seeing revenues by customs, for example, in trillions. We are seeing revenues from Federal Revenue Services running in trillions. But is that actually our ability? Can we do better? Can we do better? If we can do better, let's do better. If there are loopholes or there are some areas where some of these things are lost, let's do something about it. In terms of Federal Revenue Services, there are clearly loopholes. In terms of the net, you know, the ability of the net to even capture everybody that is supposed to pay taxes. Not everybody that is supposed to pay taxes is paying taxes. And not everybody is paying in the quantum that they are supposed to pay. Certainly that is clear. But luckily, the Revenue Act that was passed earlier this year, I think that will also capture a lot of tax that was perhaps we are missing. We are now going to get it. But I think in as much as possible, we need to tell ourselves, we need to carry everybody along. We need to ensure, you know, that we as Nigerians, we have to do some things. Now, some of those things I know are difficult also, you know, because again, this is 2022, going into 2023. For example, the price we are paying for petroleum and related products, we know is highly subsidized. Now, removing that subsidy now perhaps may not be popular, but is it sustainable? Can we continue to subsidize you know, these kind of products, I mean petroleum products, at the rate we are doing now? That is putting pressure on revenue. That is putting pressure and increasing our expenditure, and is not sustainable. Other things, of course, that are not also popular is the exchange rate. You know, it's clear. If you see the margin between the black market and the the official rate market, there's a lot of room for improvement. But I mean, we have to face this and we have to do it. And I think that is the only way we can reduce this pressure in our ability to service our debt that we are having right now.
Okay, Prof, before I let you go, talking about the debt profile at 23.27%, you agree, yes, we're on a safe margin, but does that give us room for more borrowing, since governments and citizens also need more infrastructure to ensure that businesses get to thrive? And talking about missed opportunities in the global market, talking about our oil, what's your final word on the way to go? Just
well, in terms of more borrowing, I don't see us suspending borrowings in the near term, because realistically, we have entered into some agreements already in terms of these infrastructures that I mentioned earlier, so we cannot stop it. What we can do, I believe, is to reduce some of our subsidies. You know, we are subsidizing Naira, we are subsidizing petroleum products. We can do that to improve our ability to pay on the debts. But we cannot stop the borrowings, unfortunately, as it is, because we have already entered into various transactions, and many of them are not completed, and we cannot stop midway. So that is one side of it. Now, so in terms of our ability, our debt to debt service ratio, our debt to GDP ratio, which is 23.3%, is very, very manageable. It's very, very encouraging. In fact, that means we can borrow more if we are looking at that alone. Because if you look at the profile, even in Africa here, most countries are at 90, 80, 70, 100, over 100% debt to GDP ratio. Ours is only 23.3%. So it's low on that count. But it's high on the revenue, debt to revenue. That is the one that is high. And unfortunately, we cannot reduce the level of borrowing right now, because if we do that, it will stall on a number of projects that we have started. I think we can do something in terms of reducing our recurrent expenditure. Cost of things are rising quite all right, but then whatever is not necessary, please let's not go into it, especially if it is recurrent. Let's manage with that, and I believe in a year or two, if oil prices should continue at this rate, I believe we'll be able to do very well, because the prices are now favorable, and I think it will be favorable for the economy in the long term.
Thank you so very much, Professor Shehu Ibrahim Ango from Kaduna State University. Thank you so much for sharing your thoughts with us at this particular point in time. Well, let's take a trip to the commodities market, where gold prices dipped on Friday as dollar firmed up. And it's a positive wrap on the equities market as the NGX All Share Index increased to 53,201.38 basis points this Friday. Market capitalization also gained to close at 28.681 trillion naira, 273.2 million shares exchanged hands by investors in 4,584 deals, valued at 2.646 billion naira. Transnational Corporation, GT Co, and FCMB led trade in terms of volume and value. Well, world stocks hit a two-week low on Friday as inflation jitters intensify. Here is the global market update.
World stocks rose this Friday as rate hike guidance from the European Central Bank and jitters over upcoming U.S. inflation data boosted concerns about global growth. European stocks extended losses, with investors bracing for U.S. inflation data that will help decide the course of the Federal Reserve's tightening path. German DAX dropped 1.42%, UK's FTSE 100 shed 1.11%, and French CAC slipped 1.25%. Stocks in Asia were mixed as Chinese inflation data for May came in largely in line with expectations. Hong Kong's Hang Seng Index slipped 0.29% to close at 21,806.18. The Shanghai Composite gained 1.42% to close at 3,284.83, while Japan's Nikkei 225 dropped 1.49%. In the U.S., stock futures were muted in early trades ahead of the highly anticipated inflation report. The Dow Jones Industrial Average slipped 0.8%. The S&P 500 rose fractionally, while Nasdaq 100 gained just 0.29%. African markets finished mixed this Friday, while stocks like South Africa's JSE Africa Top 40, Kenya's Nairobi All Share, and Namibia's overall index were in negative territory. Tunisia's Tun Index and Ghana's GSE Composite pointed northwards.
And now the Naira fell hugely at the import and export window. Let's take a look at official exchange rate this Friday. Well, this is where we end this episode of the program. Don't forget, you can access all previous episodes on YouTube. We value your feedback. Do join us again next week.